Portfolio bloat: what's happening to thousands of startups going nowhere fast? Earlier this week, much was made of the e-commerce business Brandless deciding to shutter its doors. Industry observers found its fate particularly interesting, given that Brandless was only a few years old and had raised substantial funding, including $100 million from the SoftBank Vision Fund alone. Still, Brandless is far from alone in having tried, and failed, to break away from its many rivals and become the kind of juggernaut that makes venture investors money. There are now thousands of venture-backed companies that once looked like bigger opportunities or whose growth has slowed, and which aren't finding follow-on dollars. Ravi Viswanathan of the venture firm NewView Capital sums up what's happening out there this way: firms and funds are generally coming back to market faster with bigger funds, and they're investing a lot more, so you're seeing portfolio bloat across the industry. But limited partners, the outfits and people supplying money to venture funds, are investing for you to make money, and that means spending time on the needle movers. So what's a startup with dwindling attention from its investors to do? There are numerous options, some newer than others, and some more desirable than others. Option number 1. Naturally some, maybe most, of these companies will eventually, like Brandless, close down. This is the least favorable scenario for everyone involved, as it means lost jobs, lost dollars, and often an uncertain future for the founders who've poured their heart and soul into the company. Venture capitalists don't love closing down companies, either, as it means writing down the holdings in their financial statements, something they're always loath to do, though external events can also impact the timing. As Jeff Clavier of the venture firm Uncork Capital explains it, we maintain a company's valuation on our books until we decide to impair it. But if a venture firm has a big gain, because another company sold or went public, we might as well take advantage and sell the shares for $1 or forego them altogether, minimizing the firm's overall tax bill in the process. Option number 2. Other companies that have grown more self-sufficient might look to buy back their shares from investors at a discount. Joel Gascoigne, the founder of a now 6-year-old social media management company called Buffer, publicly outlined his own process for saving up enough money to buy out the company's main venture investors a couple of years ago. It's not easy to pull off. Gascoigne says it took more than a year to persuade the VCs to take the deal he was offering them, and their relationship suffered as a result. The reason, offers Clavier, is that in a buyback scenario, an investor has to admit complete defeat, and that's kind of the last stop. For more on this story, visit the news article link.